a product, you're selling the same product somewhere else to make a profit at a higher price, which means their interest rate, okay, when they lend out mortgages and loans should be higher than the interest rates that they pay to borrowers like me and you when we deposit money in our savings account. So this is basically asset management. All right, so money from assets, money from assets should be more than money earned from liabilities or money paid out when it comes to liabilities. Okay, so that's asset management, and that's the second principle when it comes to bank management. And the third principle to bank management activity, okay, has to do with capital management. So this is equity or capital. And the entire purpose of this kind of management is to prevent bankruptcy. Okay, so this is to prevent bankruptcy. All right. If you look at the formula on your balance sheet, okay, for a business, a sole proprietorship, or even an individual, okay, we know that assets, okay, equal liabilities and capital. Okay, in other words, assets equal your liabilities plus equity. All right, so assets take away liabilities will be your equity. All right, so basically what we are saying is, okay, when it comes to a company, for example, their equity will be um, made up of shares that they sell in the stock market, okay, as well as treasury bonds that they buy back from the market, okay, so on and so forth. Okay, we're talking about preferred shares, common shares, and treasury bonds. Okay, so when it comes to a bank, okay, they do have an equity as well. They do have a capital to maintain. Okay, and this has to do with their assets and liabilities. Okay, so assets take away liabilities equals equity. Okay, and they need to have enough equity for them to prevent any kind of bankruptcy. All right, you need to have enough capital assets in hand for you to prevent bankruptcy. Okay, and this is capital management. All right, so that will be it for this video. On behalf of Electronics, this is Obey. Have yourself a great day.